the selling triggering stops made the market collapse. This isn't conspiracy. Read the executive order that next year they're talking about revaluing gold as part of the Bitcoin fund that Senator Lummis from Wyoming has been advocating for. And if they do revalue it, it devalues the dollar. It's not about revaluing gold, it's about devaluing the dollar to a much lower level so we can sell our products to the world. You have to bring back manufacturing. How do you do that? You peg gold to the back end of the bond market and you end up having zero upfront borrowing costs. There's like in the Shawshank Redemption, there's 2 miles of shit that we have to crawl through to get to the other side, like Andy Dufresne did. And that's what happens with the irresponsible fiscal policy that we've had and the brain dead monetary policy we've had for all these years.
In today's news recap, gold ticks higher as focus shifts to U.S. private payroll data. Gold prices firmed on Monday, holding above $4,000 per ounce as investors hunkered down for U.S. private payroll data due this week to assess the chances of an additional Federal Reserve interest rate cut this year. Gold is in the process of carving out a trading range, maybe in the high 3,000s to the mid 4,000s. This is a kind of expected consolidation after such a big move, said Marex analyst Edward Meir. The metal, which has gained 53% this year, has dropped over 8% from a record high hit on October 20th. Now, you guys, it's pretty clear that narratives are shifting from buy now, before it's even higher, to it may go sideways for a sustainable period of time. Investors are awaiting the release of ADP U.S. employment data due on Wednesday and ISM PMIs this week for cues on the Federal Reserve's policy direction. The U.S. government shutdown has halted the release of key economic data, including from the Bureau of Labor Statistics. The Federal Reserve last week cut interest rates for the second time this year, but Chair Jerome Powell said another cut this year was not a foregone conclusion. Traders are now pricing a 68% chance of a rate cut in December, down from a near certainty last week before the Fed meeting. Non-yielding gold thrives when interest rates are low and in times of economic uncertainty. Gold's pause still looks like a breather, not a breakdown. Seasonal softness, temporary Chinese policy noise, and a firmer dollar explain the short-term retreat, said Ole Hansen, head of commodity strategy at Saxo Bank, in a note. Meanwhile, China ended a long-standing tax exemption policy for some gold retailers on Saturday, potentially setting back a buying spree for the precious metal in the world's biggest consumer market. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
When you look at it from the mainstream perspective, yes, much of what they said was valid. It had gone up really unencumbered for 9 straight weeks. It was overbought. All of that's valid. All of that's true. It had busted through well in excess of moving averages, the 50, the 200. All that's true. It was ripe for a correction and a flush and a pullback, and all of that is true. And if it had been said that way, of course, they always throw in, is this the top, the 2011-1980 top, where it starts to head down and maybe, this is it, maybe look for other assets, Bitcoin or whatever the hell you want to talk about it. Look, if they would have just told the other half of the story, I would have been more inclined to acquiesce to some of their validation or to some of the things that are valid. I think by not telling the whole story, it invalidates much of what they say. The initial snowball that was pushed down the hill was in the middle of the evening after all of the markets had closed and the New York traders were in bed, and it was sold in the access market, it being gold and silver, billions of dollars worth, in the middle of the evening when there's no liquidity, when the markets aren't there to catch the bids, and instead the driving down of the price, dumping it onto the market at strange hours When it started, it was in the middle of the night. I don't remember exactly what time. And then the next day, they did it at like 8 or 9 o'clock at night, when in between New York and Asia. Again, New York's closed, Asia hadn't opened yet. You see a price that's getting clobbered, because all that does is hit the sell stops that that are embedded in algorithmic programs along the way, and they drive the price down. In other words, this was done as a drive-by shooting for an effect. There would not be a trader on the planet with a third of a brain cell that would dump all of this in at a time outside of New York trading, where that's where the price is set. That's where the bids would be. They would do it slowly and judiciously over time, even a matter of days, that amount, slowly, without alerting or waking everyone up to a dumping of metal. And they would catch all of the demand for 9 straight weeks that have been growing up. They would have got a much better settlement. In fact, they guaranteed themselves the absolute worst settlement. And so the selling triggering stops made the market collapse. Now, what they also didn't talk about, and let's just stop right there for a moment. If they would have said all of those things, market's overbought, gone up for 9 straight weeks, the technicals said this is ripe for a correction, for a flush, for a pullback, whatever validation they want to attach to it, it's invalidated by not saying, by the way, some idiot dumped it in the middle of the night when there was no liquidity in the market and there were no traders, and this is done in the access market. Nobody would do that. They conveniently leave that part out. The other part that they left out was the second day, when it was done in between New York and Asia. Again, equally a stupid time to do it. Within just a few minutes, the silver price shot right back up. Well, how the hell did that happen? Well, if you look at Michael Lynch, and he does an amazing job at analyzing the COMEX movements, he says that it was Bank of America and Morgan Stanley that came in and did the purchasing. It was European banks that did the selling, and it's commercial banks, and it was Morgan Stanley that came in and did the buying. Well, why is that valid? Well, the chief investment officer of Morgan Stanley recently came out and said the 60-40 rule of investing that Wall Street's used for, 50 plus years was invalidated now by
60-20-20.
Yes. In other words, sell half your bonds and put 20% into gold. And then that's Morgan Stanley. And then Michael Hartnett, the chief head analyst for Bank of America, says, no, 25, 25, 25, 25. 25 stock, 25 bond, 25 short-term treasuries, 25 gold. And I mean, in my whole career, I've been 35 years, they've never said that at all, ever.
In today's news recap, gold stuck in a range as trade optimism and Fed signals cap upside. Gold has been stuck in a range for the past 5 days, struggling to regain momentum after falling around 10% from the record high of $4,381 reached in October. The yellow metal remains under pressure after 2 straight weeks of declines, with uncertainty over future U.S. interest rate cuts and easing trade tensions dulling its safe haven appeal. Bullion's weakness comes despite the Federal Reserve's 25 basis point rate cut last week. Fed Chair Jerome Powell's comment that further cuts were not a foregone conclusion tempered investor optimism and lifted the dollar, weighing on gold. That cautious tone, echoed by several Fed officials, has seen traders scale back bets on another rate reduction in December, leaving gold struggling for direction. The situation in gold and silver has been the classic sell the news. As we pointed out in our channel right after major media covered the rally, it's been pretty much flat, which is great for stackers to buy more. For the same exact reason, I'd be very wary of citing any bankster promoting gold and silver now, because they're the ones looking to take the other side of the trade. The outlook was further dampened by easing geopolitical tensions after U.S. President Donald Trump and Chinese President Xi Jinping pledged to reduce trade barriers during last week's meeting in Busan. While the talks stopped short of a full trade deal, the framework for tariff reductions and increased Chinese imports of American goods helped calm markets and, in turn, capped demand for gold. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
Yeah. Maybe 5%, they would say. So the two American banks that are saying 20 to 25% allocation come in and do the buying, according to Michael Lynch. And he's got a great Substack. People should check it out. So when we talk about this, the fundamentals are fugazi. The fundamentals are strong as hell. The LBMA is being bled down. I did an interview with Alistair McLeod this morning, and Alistair's like, yeah, I see this morning that the slight backwardation is reappearing between London and the U.S. again. So all the metal that got shipped from Shanghai at exorbitant lease rates and whatever 20 or 30 million ounces that got shipped from COMEX over there to quell the problem, well, what good did that do? There's still deliveries next month and the month after and the month after. Mm-hmm. And so the physical demand is overwhelming the paper price, and it's desperation when you come in the middle of the night and dump at a time that no one would do it. It was specifically done to cover shorts and for effect, and for the media to jump on and tell half the story without saying, by the way, some idiot dumped it when no one else ever would, to maximize the worst possible settlement they could ever get. And so that to me invalidates so much of what would otherwise be valid statements. And I think it goes to show where silver is ultimately going. When the U.S. government has proposed and written into draft, and it will be accepted, that silver will become a critical mineral in this country, things are changing. And I think what we saw was a desperate attempt by some really caught commercial banks that are massively short, and the rising price, coupled with a government shutdown and trade meetings with Xi and all sorts of stuff going on. Mm-hmm. The last thing, and interest rates going to be lowered again. The last thing they wanted is for metal to get way out of control, and this is their way to stop it. But I would argue only temporarily. I started coming on your show way back when, at the beginning, I was talking about all the deliveries that were coming off of COMEX. It was very unusual, starting in 2020, because no one ever stood for delivery. The exploitation of the delivery option in London and the U.S. is something that was rarely exploited, and now it's being exploited not only by all of the BRICS nations and Russia and China and India and Saudi Arabia and all of the countries that are standing for delivery on all of the world's commodities, but there's someone got to President Trump, in my opinion, and said, if we don't do this, we're dead. We're dead, because they're draining the shelves across the globe. And so they phrase it as tariffs, and they start bringing it back. It's not tariffs, it's reshoring. All the gold and silver, billions and billions and billions and billions and billions of dollars worth of metal. So far this month, which is a non-delivery month in silver, just shy of 8,000 contracts have stood for delivery already. At 5,000 ounces a piece. So do the math. I mean, it's not a delivery month, but it's still an awful lot of silver.
Yeah, it's a lot.
And yes, it is harder, because if in a game that is just cash settled amongst coordinated players across the globe, it's easy to suppress the price. But when all of a sudden you are being challenged not only by central banks and sovereign wealth funds across the globe, but now a large, what appears to be entity here in the United States who are literally bringing in billions of dollars a month in silver onto COMEX, something's different. And you can only manipulate a market over time by pushing the direction it's going. And it was easy to do that for a long time. The fact that they are standing for delivery slowly, not so fast to break the system like we're close to seeing in London, but slow enough to bleed it all dry. And that's why I would argue that some of the metal flowed back there reluctantly, because this is how they have been bleeding down the system for the last 5 years, by slowly off-taking as much as they could out of London. And that's why London has the lowest float that they've had basically ever since they started keeping records, about 140 or 50 million ounces against 600 million ounces a day in trading. So what could possibly go wrong? And so they are standing for delivery. This is showing the cracks, and that's why we had $3 an ounce backwardation for a while. where the physical metal right now today is worth more than the futures price, and that's very rare in the commodity complex.
What do you think of today's show? Is a long consolidation already happening, or is this just a healthy pullback in a mega rally that still has legs to surprise everyone and their mother? Post in the comment section down below your action plan for November and share with the stackers your price prediction for the end of the year. Now watch this video right here because it's a perfect fit for you, and I'll see you on the other side.